what does this mean for central banks? And what does this mean in terms of the potential for new types of digital currency banks? And so joining us now to discuss all of this is Tommaso Mancini Grifoli, who is the Deputy Division Chief of the Monetary and Capital Markets Department at the International Monetary Fund. Welcome, Tommaso.
Yes, hi. Thanks very much, Jeremy. Delighted to be here.
Yes, wonderful. So, you're also a prolific thinker and writer and researcher on a lot of these topics. Have enjoyed everything that you've done over the years. But you've touched on stablecoins and global stablecoins. You've written extensively about approaches central banks might take to this, and then I think this really critical idea that you and others at the fund have put forward for a synthetic, or what I like to call a hybrid central bank digital currency model that leads us down this path to the idea of narrow banks. And so I want to start there. Maybe first just help us understand, what is a narrow bank? How does it fit with this idea of full reserve money? How does it fit with this idea of digital currency?
Sure. Thanks, Jeremy. Maybe I should introduce also the concept of synthetic central bank digital currency. So that our listeners can follow more easily.
That would be fantastic.
So a synthetic central bank digital currency is essentially a private-public partnership where the private sector issues a liability that is used by you and I to purchase assets for payments. But that liability is fully backed with central bank reserves. And that liability is issued under license. License that the central bank would extend, and in exchange for the central bank to obviously supervise and regulate the business and the institution. So this is different from what people originally called central bank digital currency, which would entail the central bank issuing a liability directly to the public. So either we hold an account at the central bank, or we hold a little digital token on our wallet issued by the central bank, and we trade that. So there's a fundamental difference here because the private sector is an important player. And when we spoke to central banks about central bank digital currency, they would all say that, well, there are advantages, there are disadvantages as well, but there are advantages. So it's interesting to consider this. But of course, it's very costly, it's very risky to the central bank, and it might deter innovation. Mm-hmm. So this private-public partnership is intended to conserve the comparative advantages of the private sector to interface with clients and innovate, and the comparative advantage of the central bank to regulate and provide trust. Now, of course, this is similar to a narrow bank because this is a specialized payment institution that issues liability that are fully backed with central bank reserves. But I would like to avoid the term narrow bank because it's so charged. This is not a narrow banking license that the central bank would issue. This is a special synthetic CBDC license that the central bank would issue, and that would have all sorts of limitations in order to avoid problems of financial stability. And I guess we'll speak about that later in the program.
Yeah, so I think it's fascinating, and it's something that we have very much gravitated to. I think in the absence of these types of charters and supervision, private sector actors are sort of driving ahead in the space. You're familiar, obviously, with the work that we do and others. But it's moving fast, right? So we see these kind of global stablecoin arrangements that have reserve models, that have 100% reserve models, that are backed by sovereign securities typically, but it's not yet hey, there's an account with the Federal Reserve, or there's an account with the European Central Bank, and it has a set of supervisory relationships. And I think, yes. But this idea of public-private partnership, I think, is really, really critical. And the sort of private sector in technology has shown incredible capacity for innovation and reach and distribution. And if you can marry that to the, the safety and soundness and the kind of supervisory rigor of leading central banks, you potentially have something quite powerful with that, emerging.
Yeah, so that's precisely the idea, Jeremy, is that we shouldn't stop. We shouldn't stop the innovation. We shouldn't rein in the innovation, but we should make sure that it happens within the confines of a regulated environment. Yeah. I mean, it's great that we have new innovations in payments. We have stable coins that are backed with relatively safe assets, but there's a bunch of different stable coins that are available. Yeah. It's hard for consumers to know which ones are really fully backed, which ones really offer a claim on the underlying reserves, and how liquid and safe are those reserves, and are they liquid and safe in all states of the world? It might work now, but not during a crisis. So there are all these questions that emerge, sure. And that pose fundamental risks to users and to the safety of the financial system. And so the idea is to address those head on, to provide a regulatory environment, an equal playing field for all the innovators, but to allow them to continue to innovate on the technological front, and to allow them to continue to interface with customers, since that's what they do well. Yeah. So that's very much, I mean, you described it very well. That's very much our idea. Now, there are differences, of course, as to how you might design this. And there's a debate as to whether the liability would be issued by the central bank or by the private sector. And so I think that, people used to think about central bank digital currency as something that the central bank would run entirely. Right. That idea is kind of out the door. We've warmed up to the idea of a public-private partnership. Yeah. And the question is how to design that partnership. So along the value chain, from interacting with customers to undertaking customer due diligence, screening customers essentially, to building the interface with which customers trade the tokens, to picking the technology, and that's essentially issuing the token, to conserving data, etc. All these steps are necessary. The question is, where do you draw the line of what the public sector does and what the private sector does? Right. And the fundamental question is about issuance, I think, is does the public sector issue and the private sector distribute, or do we also allow the private sector to issue? Yeah. And I mean, it might, and this is still up for debate. And, your views would be essential for this, because I think one of the objectives is to spur innovation. And the question is, if the public sector issues the tokens and decides on the technology, how much room will there be left of the private sector to debate? So we should have a discussion about this, how to encourage innovation.
Real discussions happening, as we speak. I think, in the absence of a specific regulatory framework, right, we've seen these sort of self-regulatory arrangements like Center Consortium, Libra Association, other things emerging, establishing technical standards, compliance standards, other things. And I do expect, we're going to see the issuance of these types of global stablecoins go from the kind of, low billions to maybe the tens or hundreds of billions. It's not yet at the scale of, $1 trillion of assets. But I think you can imagine whether with a public-private partnership model and new rules of the road that are put in place, or just the sort of vector that private sector actors are on right now, you can certainly see a world where there is a dramatic amount of these digital currency tokens in circulation. I'm curious to hear your view on whether this, and it relates to the last discussion we had with Michael, was, does this gradually change the nature of banking? Is this sort of the green shoots of the Chicago plan? Does it reduce risk? Do we find that these digital currency units, combined with things like smart contracts, create new forms of lending, but on these full reserve assets? I'm very curious in your view on zoom out a few years. Does this start to change some of the fundamental both risk-taking and operational dimensions of how banking works?
Yeah, so I think that, first of all, the intention here is not to rock the boat in the banking world. We have a fractional banking system that has served countries well, that has created risks and has moral hazard for sure. But We should tighten regulation in those cases, make sure regulation is applied consistently and forcefully, and not necessarily use new technologies to change what is wrong in banking. Because of course that would get rid of what works well in banking, and that is maturity transformation, the extension of credit, etc. So I think that the intention is that these new schemes would be limited to retail payments, at least to start. The intention is actually to build in certain design elements so as to limit the amount of disintermediation of the banking sector, to limit the amount of deposits that might migrate from the banks to the synthetic CBDC or stablecoin providers. So this might be in the form of limits on accounts, on tokens held in these wallets. It could be in the way of increasing fees on these wallets as amounts grow. That's an idea of Binzile, I think, originally. There are all sorts of design elements that could be built in to limit the amount of disintermediation of the banking sector. And I think we should also, as revolutionary and interesting and useful as these new ideas are, we should keep in mind that the banking sector is funded essentially by wholesale funding. I mean, retail funding is, a relatively small part of banking sector liabilities. It varies by country, and it varies considerably by country. But we run back of the envelope calculations based on the types of elasticities of substitution away from bank deposits, and our baseline is that there wouldn't be an enormous move of deposits away from banks towards these new systems of payments.
It's interesting. I mean, there's a lot to see evolve, obviously, with sort of stablecoin growth, and you sort of have with stablecoins, you have the ability to transact in a digital form with final settlement now with some of the new blockchain infrastructure, public blockchain infrastructure in milliseconds, with global reach, with irreversibility and very high levels of security. It's very, very attractive, even at a wholesale level, for transacting amongst corporations, amongst financial institutions, not just at the retail level, but it's fundamentally the same building blocks that are there. So it'd be interesting, to see sort of organically the innovation curve that happens in this world versus a sort of very prescriptive, designed set of rules.
No, I of course, and I understand what you mean, but that brings up the possibility or the likelihood that banks themselves will adopt a lot of these technologies and evolve themselves. This is not necessarily banks versus innovators. This is not banks versus stablecoins, etc. What is good of the stablecoin world will likely be adopted by the banks relatively quickly, or by the more innovative banks at least. Yeah, and we'll see a merge between the two, and we'll probably see also a partnership between the two. In fact, in many countries where banking sector penetration is low, many of our member countries, we've seen the take-up of new digital means of payment is enormous. But in those cases, these new means of payment have enabled customers to come online, to participate in payments, and then slowly they migrate towards banking services. And so in fact, you've seen a partnership between the payment providers and the banks. So it's not an either or discussion.
I mean, I think having watched the internet evolve over now 30 years, in particular, you have sort of these layers of public internet technology that gradually commoditize and make widely and globally accessible certain things where there were public utilities or large private sector utilities that provided them in the past, and then they just become commodity-free services on the internet. And it strikes me that this particular technological vector is leading us towards sort of payments and settlement being the equivalent of the free video communications we're having now, or the ability to share content and data widely with anyone without intermediaries. So I can see that future, and then that relationship between that ubiquitous, payment and settlement infrastructure and, let's just call it the risk-taking side of the financial system and how those work. A lot of open questions. Well, Tommaso, this has been a really wonderful conversation. It was really nice to see you, and appreciate you joining the Money Movement here today.
It's a pleasure, and congratulations on putting this show together. I should just end by saying that, of course, my views, these were my personal views and didn't necessarily represent the views of the fund or its executive board. But it's really been a pleasure to participate, Jeremy. Thanks very much.
Thank you, Tommaso. Yeah, we'll see you soon.
Very good. Bye-bye.
Excellent.